Welcome back to another episode of Property Now, brought to you by Coposit. I'm your host, Michael Carboni. My friends call me Carbs. Speaking of my friends, Jason He, the He-Man.
Hey, Carbs.
The sexiest voice in property podcasting. You're here for one last time. I wanted to take the opportunity. You're going to be away from the pod for a little bit.
That's right.
We'll still hear the sexiest voice at the end of each episode. With our
That's the
little
reason why
T's.
we recorded that.
That's why we recorded that, so we'll never forget. I think if we lose your voice from an episode, mate, the viewership tumbles. We need to hear you.
I hope that's the case.
Yeah, it is true. It is true. But good opportunity to get you back. Let the listeners hear your insights one last time for a little while anyway.
Sounds good.
And opportune time, right? Because RBA cut interest rates a couple of days ago, so we can talk. I want to unpack that a little bit with you. And also, we always see a lot of questions. I know you guys, Page, we're always on Reddit, and there's always some really cool questions from people. So we sort of unpacked like 3 really interesting Reddit questions that I want to sort of ask you, unpack your thoughts, and have a chat with you about that. But mate, firstly, RBA, they cut the rates.
How good was that?
Well, everyone predicted it last time. It happened this time. Tell me, unpack it. What's your thoughts?
Oh, look, my thoughts are, it's definitely a good time. And I actually thought they were going to cut rates the last time. So that was a little bit unexpected, especially with a lot of economists forecasting. But the thing is with the economists, when they forecast and they get it right, great job. But when they get it wrong, that's okay. It's expected. All right. So to see the rate cut this time, it was definitely a relief because, another 0.25%. So that's 3 rate cuts now. Yeah, for this year, I believe.
Yeah. And the banks are predicting more. The banks all also passed on. I think all the big banks passed on the full rate cut as well. Is that correct?
That's right. That's right. Haven't come across any banks that has not passed on the full rate cut, and I think it's a pretty dangerous move in the current environment.
It's PR suicide.
100%.
At the moment.
Yeah, exactly right. But in the past, the banks, for customers who have only recently got a loan and haven't actually experienced the bank not passing on the full rate cut, it has happened in the past, where they will pass the 0.1 or 0.15% instead of full 0.25% rate cut. So there's no such thing as that the bank always has to follow what the RBA does. And that's the same thing for savings accounts too. Right. So some banks might do the full rate cut on savings accounts. Some banks may not, to stay more competitive and attract more deposit.
That's the flip side. Hey, everyone celebrates when there's an interest rate cut, but that often means if you've got money in savings in a bank account, it wouldn't be a massive rates for savings at the moment, but that would come down as well.
Yeah, exactly
usually.
Right.
Yeah,
exactly.
So it works on both sides of the fence.
Yeah, 100%.
Yeah, lovely. What are your thoughts? are your customers and clients happy about this rate? What are you telling them?
Yeah, well, like you said, it was widely expected.
Yeah.
So I think sometimes, like last month, there was just more disappointment that it didn't happen when everybody expected it to happen. So I think this time, because everybody expected it to happen again, and it did happen. So it's people aren't celebrating or doing cartwheels. But I think the message that we're passing on to our customers is to think about keeping your repayments as it is.
Okay.
Right. And that's really important to understand, because when a bank reduces your interest rate, your minimum required repayment comes down as well. Right. But you don't actually have to follow through with that. You can maintain your current repayments. And what that means is that you're actually paying more than what you're required to pay. So automatically you're making extra repayments without you actually make any changes. Right. And because you've been making these payments on a regular basis anyway, you would expect that they're quite habitual for you. So if you don't actually bring down the minimum repayments, you're not typically going to feel much pain. And for example, I did some calculations prior. That's why I got my laptop here. And I want to get that point across, is that there's been 3 rate cuts, right? So if you didn't reduce your repayments from the beginning, right? So you'd be paying approximately $272 extra without doing anything, or just because you didn't reduce your minimum repayment on an average loan of $500,000, and that'll save you 5 years of your loan term, right? Or $102,000 of interest over the loan term. Right. So $272,000 a month might not sound like a lot to some people, or may, right? But this is an easy way to actually get ahead on your loan without making massive changes.
Yeah, love it. If you can, it makes sense, right?
That's
if you're
right.
not going to feel the extra 30, 40, 50 bucks this month.
That's right.
Some people will feel it and they're celebrating it, and they can put that towards their fuel and their groceries and their cost of living that's going up.
Yeah, look, absolutely.
But very interesting. And I know you're a big advocate of, take the 30-year loan, but pay it off faster.
Yeah, that's exactly right, because there's that. It's important to understand having a 30-year loan term doesn't mean that you can only pay off the loan in 30 years, right? Especially if your loan's a variable loan. You can pay it off in 2 years. You can pay it off in a year. You win the lotto, you can pay it off tomorrow, right? There's no restrictions on that. And when it's a variable loan, there's no penalties or any punishment or early payment fees. So the benefit of having a 30-year loan term just means that the minimum repayment is calculated over a 30-year period.
Yeah.
Right. So that means should something happen, like you said, you need the money, or the budget is a bit tight, or something like a life event's happened, you lost your job, or whatever the case may be, you can always go back down to the minimum repayment.
Yep.
So that's where I think it's beneficial, because you're actually in control.
Yeah.
So your minimum repayment could be $3,000 a month, but you can decide to pay $4,000 a month.
Yeah.
And by doing that, you're paying off the loan, 10 years ahead of schedule.
Yeah.
If you keep that up. But should something happen, you just make a phone call to the bank, or these days you can even do it on internet banking.
Yep.
And just bring that down.
Yeah.
Right. So it's all about flexibility.
Yeah.
And understanding how that can help your situation.
That makes too much sense. There's probably a question from Reddit on one of these too. But
Yep.
Anything else you want to unpack on RBAs, or should we get into these Reddit questions? Because they're always pretty cool.
Oh, look, just a call out for the lender. The banks all pass on the rates on different dates.
Yes.
Right?
Yep.
So I think it's worth calling out. Macquarie's passing it on Friday, which is tomorrow.
Oh, so before this episode is released?
Yeah, that's right.
So 2 days ago.
That's right.
If you're listening live.
So right. So most banks are passing it on the 25th or the 26th of August.
Yep.
So it's really good to see that Macquarie, which is a standout and getting a lot of market share from the big banks.
Yep.
And this is the sort of behavior that I think is good to see when there's more competition in the space.
Yeah, cool. I know I'm with St. George. They're passing it on towards the end of the month.
That's right.
And that usually means I won't see it until not the next one, but the next repayment.
So that's a good point.
Yeah.
So the rate actually changes on the date they pass it on.
So you've still built up interest
right.
from the days prior.
But I believe the terms and conditions is that they won't reduce your repayment unless they give you 30 days notice.
Correct.
So your rate's actually changed, but your repayment hasn't reflected yet.
Yeah, correct.
So that's a very common question.
Always read the fine print.
100%.
100%.
But the main thing is you're not losing out.
No.
Yeah, that's the point.
Love it, man. Fantastic. I remember the 13 interest rate increases. We're all sweating, but now 3 in a row.
That's
on
right.
The way, or not in a row, but the last 3 movements have been down.
And as expected, all predictions talking about that there is likely another rate cut, before the end of the year.
Maybe a Christmas
or
bonus.
two. Yeah.
That's crazy, man. Okay. Well, fantastic. Well, good news for everyone's back pocket, I guess. And for anyone's flexibility too. That's fantastic. Let's jump into some of these Reddit questions. I've got a few juicy ones, I believe. Mm-hmm. They're always interesting. There's always like common questions.
Yeah.
So I want to try and pick out like a bit of a fave for each sort of theme.
Yep.
Obviously can't give financial advice, so let's keep it general. But the first one is about timing the market.
Right.
So should we wait for a potential market correction before we purchase a property? And you must get questions like this all the time.
All the time.
So here's a scenario, right? Let's imagine like young couple with a child.
Yeah.
Okay. Looking to buy their first home.
Yeah.
They've got a combined net wealth of say like around 200K, maybe over 200K.
Mm-hmm.
And good savings. I think this person described themselves as like a real tight ass, did they say? Yeah, I'm a proper tight ass, they say in there. Okay, cool.
Mate, that's a compliment.
Mate, I think that's fantastic. We should all be tight asses. No, I'm just kidding. We're looking at a 900K house and land package with repayments of about $5,200 per month.
Yeah.
Torn between buying now or holding off in case there is a market collapse. The word is collapse.
Yeah.
So what do you think?
Okay, so to me, collapse is 40-50% fall in prices, right?
Yeah.
I mean, collapse might mean different things, or 20-30%, but my impression of a collapse is some sort of bubbles.
You lose everything. Yeah.
Right, and people have been waiting for that. So I think that's extremely unlikely to happen, especially in Australia, and the reason for that is that our banks have really strict lending guidelines, which is regulated by the government.
Yep.
Right. So we're not over lending, we're not overexposing people, they're not borrowing more that they can handle. And the main point around that is, and I've mentioned this a few times on the podcast, is that the bank assesses your borrowing capacity with an extra 3% on top of the rate you're actually getting the loan at.
Yep.
Yeah. So if the loan was 6%, the bank's calculating how much you can borrow or afford at 9%. Right?
Yep.
So these are safety buffers to make sure that things like a market collapse, because the idea is that if the market was to collapse, people have to sell their properties, right? There's fire sales, so they're selling their property really cheap and there's no one buying them. Right? So that's the idea. Because the other thing is that a lot of customers have properties with a lot of equity as well. Right, so their loan, not everyone's got a loan at the moment of 90% or 95%. So a lot of homeowners only have a 50% LVR or a 40% LVR. So they've got plenty of equity.
Yeah,
right?
They can take a small hit.
Yeah, exactly right.
And
it's not like they're going to go bankrupt. And also the government, and in addition to the banks, will have things in place to ensure that there's no market collapse.
Yeah, 100%.
Right? Yeah, so in terms of waiting for a market collapse, what tends to happen historically is, as you can see the data, and you can look at it specifically because property data, there's markets within markets, right? That prices continue to increase, right?
People have been waiting for a collapse in Australia for a long time, longer than we've been alive. I think people have been talking about things like this. We've all watched the Big Short.
Yep.
So we know what happened in the States, and
Yep.
sometimes we hear commentary from overseas, and it doesn't always apply to Australia, I guess. The way our government's built is different. It's almost like too big to...
that's exactly right, because in the movie The Big Short, a lot of the issues came from irresponsible lending practices, right? Like those two cowboy characters.
Yep.
Right? Like ninja loans or something, right?
Yeah.
No documentation loans, no income loans. But we don't have that here.
I'm not saying it's impossible, right? We can't possibly predict it. Who knows what's going to happen in the future? But based on recent history, what is a collapse? Is it a little? Is it 40 or 50%, like you said, or is it a little correction for a shorter period of time?
That's right.
And things continue.
That's right. And you also
which we always see along the way.
Yeah, exactly right. And you also got to factor in buying right now. How does that fit into your personal financial situation and your goals, right? Yeah. So are you renting, or you might be living with parents, or whatever the situation is? So I don't think there's you can't just put it down to how the property market's going.
That's what's interesting to me in a scenario like this. Young couple with a child. What's their current position? Are they renting? Are they renting in an apartment and they want some more space because the baby's here? Mm-hmm. Are they living at home with a parent and they want their own space as well? So this becomes not necessarily about investing. This is about shelter. So, when do you want to buy your own home and start to build your future and start to build some wealth there and plan for, your future and like have that nest egg?
Yeah.
Maybe now's the time to do that. So I would sort of say, if it's shelter, somewhere to live, your first home with your family, you shouldn't be thinking about collapses and corrections.
Yeah.
You should be sort of thinking about it as shelter and more of a long-term sort of planning position.
That's right. So I think this question also stems from, because I'm seeing a lot of questions or posts on Reddit and online about buyer's remorse as well.
Yeah.
Right. It's especially for people buying their first home. Yep. I think the fear is making a mistake.
Yeah.
Yeah. I shouldn't have bought. Because now the prices are 20% less, so I made the wrong decision. Yeah. Just like, I should have fixed my loan. Now the rates have gone up. We were talking about that this morning, right? Yeah. So I think it's that fear, and I think that fear is really dangerous, because the only thing you can do is you can make the best possible decision based on the facts today.
Yeah.
So you can't see into the future. Yes, it might come down by 20% or 10%. You might have overpaid slightly, but I think, in the scheme of the next 20, 30 years, or however long you're going to be living in this property, or however long you're going to be owning it, even if you did pay 10% more per year, it's probably an insignificant difference. Or other people who have experience where the prices have gone up, they've paid an extra 50 grand, or they think that, but now the property's gone up by 200,000.
Yeah.
Right. It becomes insignificant, but I think it's always related to the fear of making that mistake. Am I doing the right thing? Because there's no one telling you this is the right thing to do.
I think you're never going to achieve perfection.
That's right.
So you're always going to see, I could have done this better.
Yeah.
You're going to see that in hindsight always. And so I think everyone that purchases property has a little bit of remorse at some point, but you see it through for the long term, and typically they things matter less.
Yeah, exactly right.
If you're in it for the long term. That sort of leads to like the next question that we've sort of found on Reddit. The theme for this one is more about borrowing capacity, deposit size, and affordability.
Yep.
So this question is more around, should we maximize our borrowing capacity, or should we stay conservative or be more conservative? So there was a question from a poster and their partner, earning about 110K after tax and having 100K in savings. So had a bank assessed borrowing capacity of 625,000. So that means, they could use 100K as a deposit and borrow up to 625 for the rest of it. So 725 at a max. Repayments would be 3,750 per month in a scenario like this, which was about 45% of their combined salaries, which is typically all right. There's a rule around how much of your salary should go towards your shelter?
So the bank, the simple rule is about 4 to 5 times your before tax income.
Yeah, okay. The couple argued about whether to maximize the loan, so like pretty much get as much as they can, or borrow less and keep repayments low. And they asked if whether buying a home was a dumb idea or if renting might be better. We might tackle that later. But what do you think about like maxing out versus staying a bit more conservative?
Yeah, I think it comes down to your individual situation, your risk profile.
Yeah.
Right. So maxing out typically means you have to max it out because there's a particular property you need and it requires you to max out your borrowing capacity. Yeah. Right. So I think it comes down to the purchase price of the property. Right. And then based on that, what kind of buffers do you have? Are you spending all your deposit? You're maxing out your borrowing capacity. You're getting a massive loan. What happens if someone loses their job? What future expenses do you have coming up? These are the factors that you should consider. How are your actual living expenses that once you own a property, right? Because once you own a property, you have additional expenses relating to the property that you didn't have when you were paying rent.
Yep.
Yeah. So I don't think it's just a question of should I max it out or should I not max it out, right? There's several factors you got to think about, right? But let's say you didn't need to max out your loan amount and you were buying a property within budget or lower than the maximum budget. So you have the option to borrow more or borrow less. So borrow more means you keep more deposit.
Yep.
Borrow less means you're putting more deposit.
Yep.
So it comes down to what buffer or how much money you want to have left over at the end of the settlement process that you feel comfortable. Because we have clients that could put in extra 50 grand, but they choose to borrow more. So they will have extra 50 grand left over when it's all done and dusted.
Yep.
Right? And that's their buffer. Right? So that's the factors you got to think about. And in that particular situation, it's more of a question around you having a choice. But if you need to max your borrowing capacity to buy that property, you don't really have a choice if you want to buy that property.
If you want that specific property.
That's right. And if that's the asking price and you need to max out your loan amount, there's no choice. Right. So, that's what I think it comes down to.
I guess there is a choice. You don't have to buy that property. You can go, correct. Hey, you know what? We're not comfortable with maxing out.
That's right.
So we need to set our budget and our standards a little bit lower.
Yeah.
I think it goes back to your 30-year loan thing and having flexibility too. If you don't max out, you can be more flexible with higher repayments and you can sort of go up and down like that as well. So it's to the individual. There's other scenarios where you could probably like borrow a little bit more, not necessarily spend it all, but keep that buffer for like renovations or anything like that.
Oh yeah, so that's a really good point. Yeah, and that's something worth thinking about because just because you can borrow today doesn't mean you can borrow in 6 months or 12 months time. Right?
Yeah, so I've seen people, and you've actually advised me to do this in the past, where you borrow a bit more, you don't spend it all, you keep that in an offset account, and then if you need it later, you've got it there.
Exactly.
You're not getting charged interest on that because you haven't actually used it yet.
That's right.
But you've got that there. Again, it's all about flexibility with
exactly.
you, right? So
exactly right.
I love that. I've seen a lot of there's a lot on Reddit about too as well about people like, again, going back to your buyer's remorse, like you get the loan, you max out, and then you feel bad about it. Like, should we have done that? What do we do next?
That's right.
Do you come across this with your...
Yeah, we do. It's usually related to the property itself.
Yeah.
Yeah, so not often it's related to the loan or the repayment but the buyer's remorse is like, oh, you start to see flaws of the property.
Yep.
And sometimes it's because when you start living in it, you notice more things. Like, oh, the traffic noise is much worse than I had thought. Should I have spent this amount of money on this apartment or townhouse or house, or should I have done something else? Right. So it does happen, and I think and because it's such a big decision, it's common to have some remorse.
I think for a first home buyer too, you're there. It's your first loan of this size.
Yeah.
It's such a massive decision.
Yeah.
You may never make a decision like this again. You probably will once, maybe twice. Or if you're an investor, you're going to make it a lot, right? But you might see this and go, wow, I'm paying this off for the next 30 years.
Yeah.
You can feel very small at that point. I think over time you feel bigger because as time goes on, you start to maybe realize some equity, or you start to pay it down, or you start to chip away at it, or you buy your next property as well, and it becomes less and less daunting. But I think everyone might feel that remorse the very first time. As soon as you start, you feel that excitement, and then you go, wow, hold on, this is the next 30 years of my life. How old am I going to be?
Right.
You start to calculate. On the flip side of that, I see a lot of investors who pay interest only, so they're not worried about debt.
Yeah.
They're using the debt and they're thinking about, hey, can I find equity?
Yeah.
And then move on to the next. And I guess it comes down to your risk profile, what you want to do, what your purpose is.
That's right. And it's also very discouraging as well when you first take out a home loan and you paid it for a year and you realize you chipped away like $5,000 of the principal and 90% of the repayment has been interest.
Yeah.
Right. But there's positive encouragement because the longer you pay, the more of your repayment goes towards principal and less goes towards interest. But in the very beginning, the bulk of it goes to interest.
Yeah, so over time, it's more towards paying it down. And I guess that goes down to this question here, or this scenario here, where it's 45% of their combined income at the moment.
Yeah.
But that will change over the time of the loan, assuming they will probably have opportunities to earn more money over the time of the loan as well. So they may get to a position where $3,750 per month is not a lot. It becomes 25% of it.
So that's a really good point, because the debt is protected from inflation, right?
Yeah. That's right.
Right. So a debt of, let's say, $700,000 today, in 10 years' time might not be worth much.
I love that point.
Just like, you look at someone who's had a loan for 20 years or 15 years, they only owe $300,000 or $200,000. Or when they took out the loan, they took out a loan for $450,000. Yeah. Yes, I know property prices was cheap and all of that. Right?
But at the time, they would have been huge, and wages weren't what they were. And
Exactly, right? So wages are a lot higher now. So that debt is not worth the same value in 10 years' time. No, so that's pretty cool. And typically your income will continue to increase also because of inflation.
Yeah, that's a massive point. Clip it, Peach. That's a great one. I love that. Final question, man. It's a final question for a while, mate. I'm gonna miss you. I always hear your voice in my mind. The final one is about government schemes and deposit questions, really. And I hear you talking about the 5% deposit scheme quite a bit.
Yep.
So the question is is this kind of risky or is it inflationary, right? So a Redditor has a question, and we've seen a few questions like this on Reddit, but how a 5% scheme could be beneficial when a 20% deposit helps avoid subprime loans and high repayments. This is the summary. Yep. They argued that 5% loans risk borrowers taking on insane amounts of debt and might inflate house prices. So you can get in with less, so maybe that means you got more room to move and prices can go up. They asked whether better policy alternatives exist. I'm throwing this all the way over to you because I've got no idea. Okay. What's your answer?
So let's break it down. So 20% deposit standard helps prevent subprime loans. That's not actually true. So with the 5% government home guarantee scheme, the participating banks that offer that loan with the support of the government are major banks. Yep. So they're not subprime loans. So subprime loans usually refer to loans for people with bad credit history, loans for people with low documentation. Yep. That's your subprime loans, right? So that's not actually the case. The borrowers are actually good credit history and has the same requirements if you were getting a 20% loan. It's just that the government is acting as your guarantor because your parents can't be your guarantor for whatever reason.
Yep.
Right. So helps borrowers avoid high repayments. Yeah, look, that's true. If you're putting in more money, you borrow less, right? Yep. So borrowing 80% versus borrowing 95% is a difference, right? But I don't think it's that simple because, it's also the difference between being able to secure property for stability, security, shelter, right, versus continue to rent and being in the rental market and being subject to, for example, rental increases and so forth, right? So there's no, definitive answer that high repayments is bad, as long as it's affordable for you, because you don't know what the situation that people have. They might be on really good income, they just haven't had savings because they had situations or events happen in the past they had to use the savings, whatever the reason is.
Yep.
Right. It helps ensure borrowers who take a mortgage are actually financially stable enough to take it on. Yeah, that's no different. It's going through the same lending standards. If you're borrowing 95% versus you're borrowing 80%, the lending standards are the same. So you have to demonstrate affordability, and all the hoops you have to jump through is no different.
Yeah.
Right? So it doesn't mean you're a riskier borrower because you're borrowing 95%.
Yep.
Right? You're still going through the same borrowing capacity assessment, credit checks, everything else. Right? Yep. And also, how would would that cause prices to increase, inflationary for house prices? Possibly, because you have more qualified buyers now. Right? So previously, let's say people with less than 20% or less than 10%, they couldn't buy because the scheme wasn't available. They don't have a guarantor. Now they can.
Yep. Maybe more demand though.
That's right. So there's going to be more demand, and yes, it could push up the prices. Yeah, especially we're not building enough houses. But I think these policies shouldn't be looked at as like a magic wand, right? It's not just because the government come out with this one policy that's going to solve the housing crisis. They need multiple policies. This is going to allow people this solves a low deposit problem, right? This doesn't solve a supply problem.
No.
Right? So, I think ideally in the perfect world, you want to have people building more houses and making it easier for someone to buy a house. And that way, you can get more people into homes without causing prices to inflate.
It is interesting though. There's always, whenever there's an not organic change, like government are making changes or going against what is kind of natural. An interest rate cut, for example. I saw a great one from Chris Kohler. I love his videos, right? And he's saying, so interest rate cut. So I've got an extra 15K that I can borrow now. Or that can go towards my home.
Oh, yeah.
Oh, fantastic. Hey, Mr. Real Estate Agent, I've got an extra 15K.
Yeah.
Oh, that's great. Everyone else has an extra 15K as well.
That's right.
So all of a sudden everything rises, right? So there's this it's just unorganic way of changing things, So you sort of, how much of this, it's interesting. I find that very interesting.
Yeah, but you make a good point, because that helps with the demand, right? That increases demand, but it doesn't increase supply. So that's always been the argument. Same thing as the first homeowners grant, where you're just giving people 10 grand, or in Queensland.
So you think it's more about the demand side of things rather than?
Well, these are popular too, right? These policies are popular for people, right? But the real question is, yes, you are increasing demand, but not increasing supply. So when you do that, like you said, prices are going to go up. So how much is it really helping people? But that's the macro view of it. But we've got plenty of clients who've been able to buy because of this scheme. And because they could use the scheme 3-4 years ago. They bought at the time, and now they're seeing their property increase in equity by 100 grand, 150 grand. Right, and what they bought was much cheaper than what they can buy today for equivalent property, right? So that's actually helped them. Like, you can't argue against that.
Yeah, cool.
But for other people, yes,
beautiful, man,
it can happen. But I think the last point is very interesting. We're encouraging financially illiterate borrowers to take on insane amounts of debt. Look, a lot of harsh assumptions there, right? Just because you're borrowing 95%, you got a 5% deposit doesn't mean that you're financially illiterate, right? And I think that's why a lot more people are going to mortgage brokers, and the market share, I think 75%, 76%, because mortgage brokers tend to educate the customers. Right? It's not just saying because you're eligible for this that you should get a loan, right? If you understand the numbers, what the repayments are going to be, how much proportion of your income your repayments are going to be with a loan of 95%, right? Is this manageable? Do you have buffers? Right, these are the things that needs to happen to ensure that people don't fall into a trap of borrowing too much, for example. So it doesn't necessarily mean that the customers are financially illiterate, or just because you have a 5% deposit for some reason, you're financially irresponsible and you're blowing all your money, on entertainment and dining out. It's like some serious assumptions.
You could go on all day about this, couldn't you? I love it. Reddit, I reckon. You must go on Reddit all day and just answer questions, hey?
Look, I try to. But that point does, I take that point quite personally, because I really don't agree when people make assumptions that just because you're borrowing more money, you have less deposit or you don't have a deposit.
Well, we've seen that with Coposit. Start with 10K.
Yeah.
Doesn't mean...
That's right. Yeah. It doesn't mean that. Like there are a lot of people on social media talking about, it's because you've spent all your money traveling in your 20s or whatever. That's the biggest assumption ever. Like, you don't know that. Everyone's situation is different. You might come from a different family or whatever, right? So it kind of annoys me when there's assumptions made about people's financial situation and automatically they don't have a deposit, they're borrowing more money. There's something wrong with them. That's not the case.
I'm going to miss the passion, man. I'm going to miss you. It's been great having this chat. It's always so much gold to unpack with you. So thank you so much.
No problem.
He-Man, the sexiest voice in property.
Great to be here. Looking forward to coming back.
Hey, we'll talk, mate. I'm sure it'll fly. We'll talk soon.
Sounds good.
Thanks,
Cheers.
everyone.
This is Jason He, the sexiest voice in property, here to tell you that the Property Now podcast offers opinions on Australian property news for informational and entertainment purposes only and general in nature. It does not take into account your objectives, financial situation, or needs. It does not constitute professional advice. Always seek expert guidance before making any property-related decisions.